We are talking global currencies with my guest today, Christopher Vecchio. He's the senior currency strategist over at dailyfx.com. Chris, welcome back to the show.
Good to see you again, Danielle.
Yeah, good to have you up on the show as the dollar is continuing its uptrend here. Dollar index as we speak, a stone's throw away from 2019 highs. We're going to hit it?
I think it's definitely possible in the coming days. Dollar's getting a boost from two sources. One, the fact that you're seeing other central banks around the world taking a step back, getting ready to launch lower interest rate programs or new versions of easing programs already in place. I'm thinking about the ECB in particular next week at their June policy meeting with revisions to their staff economic projections, but also details to their TLTRO program. It looks like that they are envisioning a period of time beyond 2020 in which rates are going to stay low. And so that juxtaposition between the dollar's projected interest rate path led by the Federal Reserve and what the euro may see by the ECB is leading to this widening out of interest rate differentials in favor of the greenback over a longer term period of time. And so the dollar is getting some support organically that way. But secondly, there's a safe haven bid right now
where which I was going to bring up.
Right, where we're seeing the impact of the uncertainty around the U.S.-China trade war stoke demand for U.S. treasuries, and in a manner where you're seeing treasuries rally, gold rally, the yen rally. That's a pure safe haven type of environment. The dollar as the world's reserve currency tends to benefit.
And we saw the boost, like you mentioned yesterday, when the Chinese official came out saying might potentially stop the export of rare earths. All of a sudden, the U.S. dollar got a peak there. So you see this trend continuing. What about on the euro front here? What are you saying?
Europe's in a really difficult situation. I feel like the best days are behind it still, not just economically, but politically speaking. I know that over the weekend, German Chancellor Angela Merkel said that her heir apparent in her party was not effectively running the transition, and therefore it was incredibly unlikely that she would step down before the end of her term in 2021. That's about all the good news we have politically out of Europe. France is still a mess. Macron's approval ratings are still below 30%. Spain's forming a government now. Belgium's forming a government now. Italy is continuing to be a thorn in the EU side.
Right.
And to the Italian government's credit, the EU is treating Italy different than it's treating other countries within the EU. France is running a budget deficit in excess of 2.5% of GDP. Why can't Italy? And
So you're seeing preferential treatment towards Italy right now?
No, away from Italy right now. And the Italians don't like that. They say, why aren't we being given the same grace as everyone else?
But we could see a shakeup now with Salvini gaining such momentum in Italy. Could that be a game changer here?
I'm not necessarily sure that will remove the context of Italy being a problematic actor. They may change their tactics, so to speak, but I do think that Italy themselves will remain that kind of problem area because, again, the size of Italy's bond market is the issue at stake here. The old saying as it goes, if I owe you, $100, that's my problem, but if I owe you $100 million, that's really your problem. Italy owes German banks a lot of money. There's over $1 trillion in Target 2 liability still sitting around on balance sheets. And so Germany really wouldn't want to see Italy just walk out the door because if Italy does, then who's going to pay the bill?
Right. Since we're doing the tour of the world here with you, Chris, let's look to the British pound with May on her way out. What does this mean for Brexit? What does it mean for the British pound? What are you seeing there?
So Theresa May is on her way out, but it's with a caveat. They have to find a new Tory party leader first before she steps down as prime minister. The main issue here is that the next Tory party leader is very unlikely to command the majority in parliament that will allow them to have a governing coalition moving forward. And so as a result of that, it's a situation where we're very likely headed towards a general election. I know that Boris Johnson is the favorite to become the next Tory party leader, but he's now embroiled in this potential legal scandal where he's being put on trial for lying to the British public, leading and misleading the British public back in the Brexit campaign in 2016.
I just think that Europe is definitely, it's going to be really interesting to watch. Like, as you said, all these elections happening. The face of Europe can really change here.
Dramatically over the next few years. And the people who were at the helm of maintaining euro stability during the debt crisis over the last decade, they're going to be leaving their posts.
So let's tie this back, as we always do, to gold. So with this uncertainty that perhaps rests in Europe now, we don't know how things are going to play out here. Would this not be price positive for gold?
You would think so. Gold's been a perplexing asset insofar as over the last several weeks when volatility has risen across other asset classes, we actually haven't seen gold volatility rise at all. Just yesterday, it hit an all-time closing low as measured by GVZ, the gold volatility index. It's 1 month implied volatility. And typically, unlike other assets, gold benefits from rising volatility. So if you see the VIX go up, it's bad for stocks. But when GVZ rises, it's typically good for gold. So this environment where volatility is up everywhere else and gold's not benefiting, it's somewhat of a shocker. But recently, gold prices have stopped falling. And I think that's a key caveat here. As volatility has gone down, gold has stabilized, potentially forming a brace.
But nothing's happening, Chris.
Nothing's happening here, indeed. We are looking from a technical perspective that over the last 5 weeks or so, we've been trading in about a $22 range, but for 4 days in the middle of May there. Ultimately, if we get below 1266 over the next, we'll call it 2 weeks, that means we're going to break an uptrend going back to the lows we had last August. And that point, we would say we'd have to take on a more bearish point of view. Otherwise, if we get through 1288 in the next 2 weeks by middle of June, odds are going up that the path of least resistance would be higher.
Speaking of volatility, let's wrap here with your thoughts on Bitcoin. It was at 9,000 earlier this morning. We've come back down a little bit here, but is the bull rally alive here?
I think it is. One thing that we've been watching for at least the first 5 months of 2019, something that wasn't on our radar until really the end of last year, but has been the relationship between Bitcoin and emerging market currencies. And the leading currency for some time between September and this past April was the Turkish lira. The rolling correlation on just going back to September 1st was something like 0.78, very statistically significant. Now, over the past month, the currency with the highest correlation to Bitcoin has been Dollar-Yuan. And so the fact that we've seen the Chinese Yuan weaken so significantly as these trade war fears have increased has been that catalyst needed for Bitcoin to rally. In an environment where the global financial system looks like it is potentially at risk because of the world's two largest economies going at odds, people may be looking for alternative avenues to find ways to circumvent the capital controls being put in place, ways to move their money around without the Chinese or U.S. governments taking stock of it.
So would you not be surprised if you saw it go back to its yuan of close to 20,000 or yuan or?
That would be a lot for me right now. I think we need to see a lot more weakness in the yuan, and in that event, that means Dollar-Yuan going past 7. Dollar-Yuan going past 7 would be a kind of world on fire type of event. Chinese policymakers do control their own currency rates, and so moving it beyond 7 would be seen as effectively an escalation in the trade war to a new realm altogether.
Chris Vecchio, you need to stop by more often. Thank you so much for coming on.
Appreciate you having me again.
She ain't mine, but she looks fine. Gonna take some time, gonna make her mine.